Okay, thank you. The overall theme of theme 1 is what explains comparative long-run growth performance, and we split it into the 3 sub-themes that are listed here, and which I'm now going to go through one by one, just to give you a brief overview. So starting with theme 1.1, measuring productivity performance, what did the long-run data show then? I think one of the central aspects of this has been updating the picture of long-run economic development over the last 1,000 years or so. Until recently, that was the Maddison data set. And the problem with that is that the observations in the early years were really better described as guesstimates. They operated in 1990 prices, 1990 international dollars. In 1990, the World Bank thought of the poverty line as $1 a day. So the lowest per capita income you'd expect to see would be around about $400 $1990. And that's where Maddison starts in the year 1000 and then joins up to the more recent estimates. Now, in fact, it wasn't strictly necessary to do that. A lot of information has survived in both Europe and Asia, and historical national accounting work has sort of integrated that into reconstructed historical national accounts. Quite a lot of the series actually have been produced by people working at Cage. We have new estimates from Cage authors for Britain, Spain, Portugal, Denmark, India, China, and Japan, spanning Europe and Asia. I wanted to just give you a brief overview of the work we've been doing here by showing you what difference this makes. So over on the left-hand side, you'll see the Maddison data. You'll see in around about the year 1000, right at the beginning, in the Maddison series, all countries at about $400, $450, $1990. And then they're linked up to later observations, which were data-based. But you can see a general pattern of quite strong growth over the period as a whole. Over on the right-hand side, we have the data-based estimates. And you'll see a number of quite big changes. So whereas in the Maddison series, everyone's at about $400 in the year 1000, the observations we actually have from the data are for Italy around about 1,000. That's 2.5 times subsistence. That's quite a big difference from being at subsistence. And the blue observation around about 1086 is for Britain. That comes from the Doomsday Survey. What you'll then see is that because they're starting off at a higher level, growth is much slower subsequently. And indeed, a second feature is that it's rather limited to Northwest European economies. We have the blue line is for Great Britain, the sort of red-orange line is for the Netherlands. Those both grow up and over time, and starting from being relatively poor, they end up being the leading economies as they go into modern economic growth. The other lines, the yellow is Spain and the grey is Italy. They don't trend up at all, really. So this growth is confined to Northwest Europe, really. For Asia, the situation changes even more. Pretty much in the Maddison data set, all the economies, so that's Japan is the orange, yellow is China, and grey is India. They're all pretty much flatlining at around about $400 to $500 $1990. So there's not much action there. I've included the blue line is again Great Britain to show you how you get this great divergence between Europe and Asia. Over on the right-hand side, we see the revised picture then arising from the historical national accounting data. first big change is look at China. Instead of being at $450 in the year 1000, it's around about 1,000, sort of 2.5 times richer. What happens then is it remains at around about that level until we get to after 1700, the Qing dynasty. We see this decline, and I think perhaps the other thing, time is short, the other thing I'll emphasize here is you can see what's happening with the great divergence between Europe and Asia is well illustrated here by the fact that Britain, the blue line, is accelerating from 1700 and China is actually going into decline and shrinking. And I'll come back to the significance of that shrinking a little bit later. Now, let's just think through some of the policy implications here then. I think the first thing is that modern economic growth in both Europe and in Asia, so in Europe it's led by Britain, in Asia it's led by Japan. They are, in both cases, build upon earlier development. And again, worth emphasizing, the key development here is avoiding periods of negative growth or shrinking. And that's really important for understanding the path to economic development. It's not so much about growing faster as by stopping shrinking. Second thing that we might emphasize here is the importance of comparing levels of per capita income as well as growth rates if we want to understand economic performance. If we move forward in time a bit to after World War II, the period 1950 to 73 looks rather impressive if you only think about the growth rate in Britain. It's the highest growth rate compared with earlier periods and also subsequent periods. On the other hand, before you think that's a good performance, we have to bear in mind it's a period when Britain fell behind many European economies. It's the worst period of relative decline. And establishing and understanding Britain's productivity failure in that period is an important sort of precursor of the productivity puzzle that we were all thinking about just before the break. Lastly, let me just say these revised estimates of GDP per capita have quite important implications for shares of global economic activity. We had a hugely higher level of per capita income in China at the year 1000 than what Maddison thought, perhaps 2.5 times higher. So actually the shares of China and India before 1800 are much larger than people have been thinking. And interestingly, this was perceived in Europe at the time not as a geopolitical threat, but as a trading opportunity. Maybe we need some thinking along those lines now. That's theme 1.1. Theme 1.2 is asks how do geography, human capital and institutions affect long-run growth. So we need to explain these long-run trends. Here at Cage, as we're going into Cage 2, having established those trends, we decided to focus on 3 main areas. Partly that's to do with capacity at Cage, what do people know about and have the expertise to make a contribution here, but also I think areas where there'd been interesting conceptual developments. And those were geography, human capital and institutions. So on geography, we were building on breakthroughs in new economic geography, and that's certainly very much inspired the work of Nick Crafts, Alex Klein, Dennis Novi, working on the importance of changing trade costs, agglomeration effects, and market access in explaining the concentration of industrial production in the 19th and 20th centuries. On the human capital side, Sascha Becker has played really, I think, a key role here in a new literature reassessing Max Weber's hypothesis on the Protestant work ethic So the idea would be that reversal of fortunes we saw in Europe of the northwest European economies overtaking the Mediterranean economies, Max Weber explained by the Protestant work ethic. I think this new work is suggesting it's more to do with education, people being encouraged to read the Bible, therefore had to be literate, and that was raising human capital. On the institution side, we've had John Wallis extending the path-breaking work of North Wallis and Weingast, looking at the role of elites in the transition to an open access society. So before we get to mass democracy in the 19th and 20th centuries, we have reforms amongst the elite, which then lead the way on to open access. What are the policy implications here then? I think firstly, geography matters for performance, and a country might have absolutely fantastic high quality institutions but still fail to grow if it's surrounded by low-income economies or if trade policy denies access to more distant markets. On the human capital side, then, we're seeing education already a crucial factor in development, even going back to the 15th century. I believe that's continued to be the case through to today. And thirdly, bad institutions can hinder growth. One of the interesting things, though, as we've delved into this, is that it's relatively easy to point to bad institutions, much harder to explain how do you actually change them. And I think one of the reasons for that is that we don't understand very well at this point how institutions got better in the West. If we were to go back 400 or 500 years in the West, you'll see institutions like in Zimbabwe or whatever, but in Britain, France, Italy, and so on. And that's, I think, something we really need to prioritize, understanding that. Finally, theme 1.3, this is what is conducive to maintaining productivity growth in the long run. And here I want to come back to that long-run data on GDP per capita, which I showed you earlier. John Wallis and I have been looking at annual frequency data in Europe to shed light on why it is that we get this overtaking of Britain and the Netherlands compared with the Mediterranean economies, and how when we looked at these annual fluctuations and the general trends, it became clear that the difference was all driven by what was happening on the shrinking side rather than on the growing side. So let me just take you through that very briefly. This graph is the annual data on GDP per capita in Italy is the grey line, Spain is the yellow line. What you see here, besides the sort of very high frequency ups and downs, is clearly periods of a decade or two where you have positive growth and then it goes into reverse. Sometimes it's a sharp crash, other times it's a trend decline, but what you don't see is overall growth between about 1300 and 1800. In 1800 you're back to the same sort of level as you were in 1300. Now here's the British and Dutch cases. What you can see here is that after a big increase following the Black Death in the mid-14th century, per capita income rises for the next half century. By 1400, GDP per capita has gone up by maybe 30, 40, 50% even. But then it remains on a plateau. In a Malthusian world, you might think after the population decline, yes, per capita incomes go up, and then as population recovers, per capita incomes will come back down. Doesn't happen in Northwest Europe. Already, they've learned, or these economies have learned how to survive the extra population growth without a decline, without shrinking. That pattern's already established then by the 15th century, and we see, again, no further serious decline. So absence of shrinking is what really matters here. When we superimpose the Northwest European countries onto the Mediterranean economies, we see you get this reversal of fortunes, what we call the Europe's little divergence. Just finally, in work with Lee Gardner, who's also here, we've been sort of applying this analysis to the case of Africa during the 20th century. We've reconstructed GDP per capita for the basically former British colonies, and you can see that these economies have been growing quite steadily since the 1990s, and that's made some observers optimistic that they're now on the path to convergence. On the other hand, when we look at the historical data, we'll see that this is not the first episode of growth. Going back to the late 19th century, you can see plenty of examples here in these three economies, Ghana, Nigeria, and South Africa, periods of positive growth, and they're typically followed by either a crash or a period of steady negative per capita growth. So, I think the policy implications here are that although there's been this period of growth recently, there are also signs of reversals in several countries. That suggests to us that the risk of shrinking remains. And we think the priority for these economies is to focus on avoiding shrinking. Steady growth at 2% a year is better than rapid growth followed by a crash, which removes it all and sets you back where you were.